my colleagues in the room tonight are all giggling about the fact I'm being called the word good and Simon Massey are put in the same sentence. Thank you. I hope not to disappoint. Menzies has been going 100 years this year in this area. We are chartered accountants, tax advisors, and we've been going 100 years giving advice to owner-managed businesses and individuals about their affairs. So we're very happy to still be here and still be doing all this sort of stuff. Today, tax is big news today, actually, funny enough. If anyone's seen the front page of the Times, the headline on the front page of today's Times is tax avoidance, or tax avoiders, I think it says, and a picture of Jimmy Carr, comedian. And apparently he's been involved in a very sort of fancy tax scheme that's dropped his tax rate down from effectively 50% down to 1% on something like £3 million worth of income. Sadly, I'm not going to talk to you about anything like that today, because I'd rather deal with things that we know are cast iron, are the law, are tried and tested, and that work. Because clearly the things he's doing don't work. Some of the things I'm going to talk about tonight are new and changes in this time's budget. Some of them are proposals. Some are revision. I'm not going to ask you to repeat what I said last time or to rehearse what I said last time, but some of the things I've said before are worthy of repeating as well, so some of it's revision. So the list of things on there is a canter through, as with a racecourse, the sort of things that we're going to be talking about this evening. So tax relief for interest paid, some changes and some revision as well there. Just some revision on other expenses, and just to emphasise some of the points that some of the other speakers have been making. A reminder about capital gains tax rules, very important and oft overlooked. There have been some more big changes in stamp duty land tax this year, important things to bear in mind. There's also a consequential possible change to the conundrum as to whether you should own a property personally or within a company, or properties within a company. And just a comment on the way the revenue are approaching inquiries and that sort of thing nowadays. So, without further ado, interest payments. This is the revision bit. HM Revenue and Customs allow tax relief for interest paid on qualifying loans. And a qualifying loan is one related to property that's being rented out. It doesn't cover repayments, it doesn't cover endowments, it doesn't cover life cover on that mortgage, but it does cover the interest. And the maximum value of the loan that you can take out and get tax relief upon is the value of the property when it was first let. And here's an example I prepared earlier. So if your house originally cost, let's say it's a house, you bought a little flat or a house or whatever for £120,000 and lived in it for a few years. And then a few years later you decide to buy somewhere else and let this property out. The value when the property is let out is £175,000. So you could borrow up to £175,000, assuming you can find somebody to lend you that much money on that property. There's the problem. And get tax relief on that borrowing. You don't have to take that loan out on the day you start letting it out. You could actually take it out 5 years later, up to the value of the property when it was first let out. You don't actually have to spend that loan on buying property. You could actually spend the loan on fast cars, going on a cruise, betting on horses at Sandown Park races. You know, you could do what you want with the money, but the loan exists and the interest will be able to be set against the rental stream. The other thing just to bear in mind is that you pool all of your rental properties together, and so if you're able to release equity on a few properties, you might find actually you can, by taking these rules to the natural extension and extending your borrowing as far as you possibly can, if you want to do that, that you actually are able to shelter a lot of your rental profits by loan interest alone. And the final thing just to bear in mind in this example is that, for example, you could just release equity on your buy-to-let portfolio to facilitate the repayment of your personal mortgage on your house, therefore converting your tax relief for your mortgage into, well, actually getting tax relief on your mortgage, whereas you're not on your own house. So worth thinking about. And I think with the financing arrangements for buy-to-lets being better now than they probably were 2 or 3 years ago, another one worth considering. However, the budget might have changed this. The proposal, and it's consultation at the moment, and I've got a 50-odd page consultation document sitting over there if anyone's brave enough to read it, is that from April 2013 there is going to be a restriction on the tax relief for certain expenses. The things that got all the press were pasties and caravans and charities. I got lots of press a few weeks ago. The charity tax thing was linked in with what I'm about to talk about here. And the Chancellor's backed down on the charity side of it. At the moment, there is no back down on the other aspect of it. And the other aspect is a restriction on the offset of deductibles against other income. And we understand, and as I say, this is still subject to consultation, that this could include interest on buy-to-let properties. And the restriction is £50,000 of expense per annum or 25% of your income. And I've given you a little example there. So if your income is £75,000, then the interest cap will be, or the cap of these will be £50,000 a year of interest. If your income is £280,000, then the cap will be £70,000. So just giving you, a little worked example about how this cap works. We've gone through our client base, and we think there's a tiny handful of landlords who might be affected by this as things stand at the moment, if this were to come in. And we've told them. We've told the ones that we think are affected that we think they're affected by this, or we're working through that process. It may well be that actually this doesn't come in this way, or it comes in a slightly different format. The whole point about government consultation, and the process ends at the end of August in this consultation process. The whole point about government consultation is that they set out, I have found, they set out a reasonably draconian set of rules, and then they reel back ever so slightly from that set of draconian rules, and you think you've actually won something because actually they've done something that's going to tax you 100% or something, and they reel back to 95%. You think, oh yeah, well, brilliant, we're 5% better off, but actually you're not. You're 95% worse off. But anyway, that's called spin, I suppose, isn't it? So, in the main, if you've got a reasonable sized portfolio with borrowing on it, £50,000 a year of rent of interest per person. So if it's jointly held between husband and wife, then actually, you're talking about £100,000 of interest here. It may not be a big issue, but I think it's one of those things to watch and listen about and bear in mind for the future. Other expenses. So other expenses, you can claim income tax relief on a whole raft of other expenses. The watchword is wholly and exclusively. Are the expenses incurred wholly and exclusively for the purposes of the letting business, the revenue now called property letting, a letting business? And your claim is made on your self-assessment tax return. I'll come back to the revenue approach about self-assessment tax returns in a minute. Types of expenses, exactly what it says on the tin. What do you expect you can get tax relief for? You can get tax relief for. So letting agents, accountants' fees, lawyers' fees, contents and buildings insurance, cleaning, gardening, utilities, a bit of time at home and computer time at home and that sort of thing, doing your accounts, Some capital allowances in certain circumstances, reasonable journeys to visit your property for the odd drive past here and there, 45p a mile, that's tax-free as well for you. And then if you've made a loss after all of those costs, you can carry forward the loss and set it against next year's profit. And also you pool all your properties together, so if you've got one that's empty but with costs and is between lettings and another one that's being let profitably, you can actually pull the two together for tax purposes. If I just refer you back to the comments that I think all three of the speakers talked about actually, was just making sure you've got a property that looks right. Actually, it's probably the best way to describe it. Am I right there? Yeah. Looks and feels right. As you walk in, it's got that sort of, oh, it looks all right, that's fine. And this is where this comes in, the repairs. And I think Christopher might set me up for a fall here, hopefully not, but hang on. That's all. Yeah, repairs. So what is a repair? It's not an improvement. New windows, question mark. And some of you might have seen me, heard me talk about these before. New windows, we normally find, are a replacement. They're not a repair. So, for example, if you've got, I think these ones here are actually single glazed, aren't they? And the wall and the windows here, they're metal frame single glazed windows in this room. Nowadays, you'd replace with plastic, if you can, plastic double glazed units. It's cheaper to buy one of those than to actually buy a single glazed unit. The revenue accept that the replacement of a window is not an exact like-for-like replacement in that scenario. Redecoration. Well, redecoration is absolutely fine. If it's a new extension or a new property that you're decorating for the first time, that is not an expense. But if it's property that's been let and you're redecorating it between periods of let, absolutely fine. And the scale of the redecoration is no real issue. Damp treatment, no problem at all. I've probably told the story before, but I had a client who replaced a roof on a property. It was owned by a trust. It had been let for 100 years. It came back into their possession and was going to be relet, and they replaced the roof after 100 years, and after a little bit of a fight with the revenue, probably about 18 months actually, but anyway, after a bit of a fight with the revenue, but we're talking about £25,000 worth of roof, we were able to agree with the revenue that that was not an improvement, it was simply a replacement and brought the property back to the state it was when it was first let. And that's the point. And this is also the point about, without wishing to be too sycophantic for leaders here, for some of the things they do in terms of schedule of conditions and photographing condition in properties and that sort of thing. If you can go around, if you've got a little portfolio that says, right, when we first let this property, here's a little portfolio of all the pictures of the property as it started out, and then you repair it and redecorate it back to that state, it's a slam dunk, I suppose, is probably the best description, in terms of agreeing that that must be entirely deductible for income tax purposes. Or corporation tax if you're a company. For unfurnished property, you can get some renewal costs as well, like I say, freestanding movable fixtures and fittings. And for furnished property, you could also claim wear and tear allowance for the furniture and fittings in the property. Or you could go for a renewals basis. You've got to be consistent. Capital gains tax. I'm not intending to give you a lesson on capital gains tax, I'm just trying to give you some pointers. You pay capital gains tax on the difference between sale price and the original cost, less any other improvements you pay, and it's on the game. Everyone's got now a £10,600 annual capital gains tax exemption. It didn't change in the budget. And you pay capital gains tax at 18 or 28%. Most people will pay at 28%, but if you're a basic rate taxpayer, then the proportion of your gain which falls in your basic rate limit will be 18%. I'm not going to talk again about 18% though today, because I think it's a confusion in terms of what we're doing. If you work on 28% capital gains tax and then are pleasantly surprised from part of the bill That's probably the best way to go about things. So, I'm a numbers person. I like to do things by numbers. So, a higher rate taxpayer bought a property June 2008 for £100,000 and it's sold in May 2012 for £150,000. Please bear in mind, I've entirely made up the numbers, and we're living in fiction land where property values do go up at that rate. So you know, I probably should have taken 10 years off of the dates, but the tax rules wouldn't have worked. So, what's capital gains tax due? So we've got a sale price of 150, less cost of 100, gives you 50,000 gain. We've got a tax-free exemption of 10,600, it's £39,400, taxed at 28%, which is £11,032. Simple. We've got a solicitor over here who's pregnant, so the word family planning on here probably isn't the most appropriate use at the moment. Family planning. Husband, wives, civil partners. Transfers of properties, or in fact any capital asset between a married couple or civil partner, is tax-free. There is no capital gains tax triggered in the main on a transfer of a asset like that. There are some odd examples where you might have some other tax consequences if one of the parties was not domiciled in the United Kingdom, but I'm going to move over those for the sake of keeping on pace today. If you move assets between, you can take use of capital gains exemptions. So, for example, same person, same example, same property, and then, so the property was sold May 2012. 1 hour before the property is sold, it's split in half. So it's split between husband and wife. And we have saved £2,968 off of our capital gains tax liability because we have 2 capital gains tax exemptions to use. Very simple, very effective. And all you need is just a declaration of trust to say the property is now not held in the wife's name, it's held in the husband and wife's name immediately before sale, and then it's sold. So it shouldn't cost you a huge amount in terms of professional fees, but it does have very significant amount of saving. This, of course, assumes you're not using your capital gains exemptions anywhere else. I had a conversation with a client on Friday, Friday, on this very subject. The scenario was that this individual bought a flat 20 years ago, lived in it for 5 or 6 years, then started renting it out when he moved in with his girlfriend, now wife, left the house that they moved into together and have now bought a third house. So they have 3 houses. 3 houses he's ever lived in. First one was his own flat, second one was joint with his wife, third one's joint with his wife. 1 and 2 he rents out. Property 1, his own house, he is now selling. And the scenario there is it's 20 years, and so he's got various exemptions he can use. So there are various exemptions for principal residence that you can actually have. The one that everyone gets, or 2 that everyone get, are there's no tax payable when you actually live in the property. And the second one that everyone gets is 3 years for any purpose. So you get another 3 years thrown at you for nothing. There are other ones where you use it for work in or outside of the UK, or moving in and outside of the UK, and there are various extensions to the limit. So if you are or know of people who have rented their property out and they've lived outside of the United Kingdom, then there's some very sort of generous exemptions there to the principal residence exemption. If anyone ever wants to know what a principal residence is, all you need to do is go and ask a member of Parliament, because they all know these rules very well. In addition to all of those, if you sell a property that you lived in as your main residence and you've let out, there's a £40,000 per person lettings exemption. The issue, and it's nearer the top of that slide there, that you just need to bear in mind, and we've had a sort of vague sniff at this from the revenue this week, last couple of weeks rather, is sort of quality of occupation. Because there is this slight misperception that you can just pretend somewhere is your main residence and that then you can get out of the tax exemption. That is not the case. You actually have to genuinely have used it as your home. It doesn't have to be your main home. I mean, for example, it could be a weekend retreat. It could be your holiday home. Let's say, for example, you work in London and you've got a house in Devon, which is actually the example I'm thinking about with my client. And you rent a place in London and you've got a bolt hole in Devon that you go to when you can. Well, if it's the place you go to when you can and you don't own another property, fine, not a problem, it's your principal residence. But if it's just somewhere you're pretending is your principal residence because you don't have anywhere else, you might struggle. You might struggle. And I think the revenue are kind of onto this at the moment. If I just come back on my client, I didn't put the example in, but for my client with a 20 years property, so he lived in it for the first 7, he's got 3 years for any purpose, so that's half of the gain is outside of the tax net, without trying, and he gets £40,000. So if the property cost him £100,000 and it's now being sold for £200,000, there's a gain of £100,000, £50,000 of that gain has just disappeared under dates. So 7 years at the start, 3 years for any purpose. Of the remaining £50,000 of gain, he's got a £40,000 lettings exemption, gone, and I couldn't make this up better, could I? And there's £10,600 of capital gains tax nil rate band, so he pays no tax on that gain of having had a property for 20 years. Now, those numbers spookily work out quite neatly. Not everything will. Some people will have some tax to pay. Some people might need to move things between husband and wives to use double exemptions. Some people may need to be a bit more imaginative about use of losses and that sort of thing. The issue is actually, with all of these, is planning before you sell. Don't come to an account, well, come to an accountant afterwards because we might be able to do something. But if you come to us after you've sold, our options for assisting you will be restricted. If you come to us after you've sold and after the end of the tax year, our options for assisting you will be even less. So, in order of priority, talk to us before you sell it. If you've already sold it, talk to us before the end of the tax year. If neither of those happen, talk to us anyway, because we probably will be able to save you something, but with decreasing benefit, I think, as we move down that decision tree. Stamp duty land tax. This is the mansion tax that Vince Cable was trying to bring in but didn't really. In the budget, we now have I'm saying here, well publicised attack on loopholes. Tax avoiders seem to be pariahs at the moment, and I think it's probably on the back of there being lots of people punting around tax avoidance schemes, which none of us are necessarily convinced they actually work. And the people that are punting them around are doing it because they think they can make a quick buck on them, I think. The government, I'm not entirely sure they're hitting the right target here, but they are hitting a target with this sort of mansion tax. And what they've done is they've put in an extra rate, or 2 extra rates of stamp duty land tax. If the property is worth more than £2 million, flat rate stamp duty land tax is 7%. What I gather has happened to the residential property market in central London, particularly because this is where it really hits, is that it has now altered pricing somewhat, so that properties are either marketed at £1,999,000 or about £2.5 million. There really aren't that many properties in that sort of £2 to £2.5 million zone, I gather. Second point is that if it's acquired in I'm saying company, but there are a few other scenarios where it could be acquired in a non-natural person. So it's not a human being buying it. Why the government, why do draftsmen actually have to use a phrase like non-natural person rather than not a human being? I don't know. Anyway, so if it's not a natural person, probably a company, stamp duty land tax on acquisition is 15%. Ouch. And it gets worse. I'm supposed to be saving the money here, aren't I? What I'm doing here is telling you how not to structure things. And really, I think the message here is, don't bother with a company. But anyway, carry on. So from April 2013, this is a proposal. If the property is worth more than £2 million, there's a revaluation every 5 years, so you won't be caught on sort of, it was worth £1,900,000 when you bought it, and then you never have to get involved in this. There's a wealth charge. If the property is worth between £2 million and £5 million and is in a company, there's £15,000 a year you have to pay the government. If it's worth over £5 million, it's a bigger number and a bigger number and a bigger number. I think up to 20 million, once it's over £20 million of property, which is in the realms of fantasy, I suppose, but it's £140,000 you have to pay. But frankly, if you've got a house worth £20 million, then you probably could afford paying £140 grand anyway. There are some exemptions to these rules and to the stamp duty land tax rules if you are a genuine developer, but it seems to catch certain financing models for property development as well. So once again, it's all consultation. The consultation is open on this until the end of August, so we don't know what the final law is, but at the moment it seems to me that the government are turning the property industry back on its head and really saying you really shouldn't be trying to structure things through a company. Which my last question here probably might help. In the main, I don't think it's beneficial for residential landlords to structure property through a company because you have a double tax charge. You have a double tax charge in that you have capital gains tax on sale of the property in the company, and then you have a tax charge on extraction of the property from that company. The main reason people have thought about structuring property in a company is because the rate of corporation tax is much lower than the rate of income tax. And so if you've got a rent roll of £100,000 and you're a 50% taxpayer, you pay 50% income tax on your rent roll or 20% income tax if it's in a company. So I can see the attraction there. But if you roll back to what I was saying right at the start of this presentation in terms of the way interest is deducted and releasing equity from interest to repay your personal mortgage, etc., 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 and structuring your finances and your affairs carefully, I don't think most landlords actually have an income tax liability on their rentals. I think most landlords, when you've certainly at the outset, once you've taken account of interest and other costs and all the other things, you have a limited liability to income tax. And certainly the clients that we look after have a limited exposure to income tax when they're very high earners. So massive generality there, but I think the changes in the way the government are approaching property and companies, coupled with the fact of the added complications anyway, to my mind, generally means, and also it's very inflexible, means that structuring something within a company is probably not a good idea. Task force. Sounds like a cheesy cartoon, doesn't it? The Revenue have a task force looking out for landlords with more than 3 properties. And they are going to be looking at your tax returns and trying to make sure that the tax position is actually correct. Are you presenting an accurate set of results? I don't quite know what this is intending to achieve, and I don't know whether the Revenue are aware or consider that there's a load of abuse in terms of non-reporting of rental income and that sort of thing. I'm just not sure. They've done a series of these kind of task force approaches, and what they tend to do is they tend to focus on a particular area of taxpayers. Now, they've picked on plumbers and electricians recently. Well, you can kind of get that. They've picked on doctors. Why? Well, expenses. Doctors apparently were not good at recording their expenses properly, and they just put sort of round sums in and that sort of thing, and sort of you know, the way they were tracking their expenses was allegedly not quite accurate. So I can kind of get that. They've had a go at accountants. Heaven forbid, why would they want to do that? So I think landlords are the next target. They're working through things, and you know, years ago they looked at, you know, Chinese takeaways, fish and chip shops. They're looking at restaurants in London, I think, at the moment, aren't they, chaps? So you know, they've got these task forces. They sort of focus on particular areas for a year or so, and then they just leave you alone for a while. So they shake you up, make you all a bit frightened about what you're doing, and then move on. So with appropriate advice, with appropriate assistance, I don't think you should be worried about these sort of things. If you get it wrong, there are penalties from the revenue, and they're approaching them in a pretty nasty way. If you get it wrong, or if the revenue approach you, then they think their powers are greater than we think their powers are. And so we've had a number of arguments with tax inspectors recently about whether they can go back 1 year, 3 years, 6 years, or in a few cases 20 years they've been trying to do, and we've been fighting off those kind of approaches as well, because you know, an adjustment in 1 year's tax return is kind of acceptable, but if you've been asked to make an adjustment in 20 years tax returns, where on earth is the money coming from? By way of an anecdote, I went to a presentation the other day about the American tax system, and I gather there are penalties in their system that are based on, if you don't disclose, say, a foreign bank account, the penalty could be, I think, 35 to 50% of the value of the account. Not of the tax you haven't declared, of the value of the account. So my parting comment here is, just be grateful we live in a country where penalties are based on on the tax outstanding, and are actually only at 20, 30%, probably worst case, 20% of the outstanding tax and duties that you might have to pay. So the good news is I'm saving you money by not being in the United States. There you go. Thank you very much for your attention and your listening this evening. I hope you've picked something up. I am accompanied today by 4 colleagues: David Kerrs, Andy England, Paula Netterton, and Eileen. I can't see you anywhere there. Eileen Miller. So any questions? They're much better than me at answering questions. So thank you very much.